Good morning, everyone, and welcome to this morning's workshop and a very snazzy Zoom room. This is really exciting to be in such an amazing studio. I'm really excited to be hosting today's workshop, Smart Investing for Busy Women, with Allbright and eToro. My name is Courtney, and I head up creative strategy at Allbright, and thrilled to have everyone here, especially as it's such a glorious morning outside. Well done for joining. The next hour is not only going to be really important, but I think you're going to find it really informative and really impactful. As we get started, we would love you to turn your cameras on. I can already see some faces, but it's always really nice to see faces of the community, and we want this to feel as immersive and interactive as possible. We'll be running a Q&A throughout the session, so pop questions in the chat box and I'll read them out at the end, or I'll invite you to have a conversation and invite you up to speak. Just before we get started, a little bit about our partnership with eToro. So, helping women take control of their finances has always been a huge part of our mission at Allbright. We believe that financial learning is the root of empowerment and the key to unlocking opportunity for us all. It's always been our ambition and our commitment to equip women with the tools and confidence to own their futures, and ultimately, financial independence is a key part of that. Personally, I think if we want true abundance and freedom, we need to have more than one income portal beyond just our day-to-day salary. And as you'll learn later in today's presentation, it is never too late to start. That's why our partnership with eToro over the past year has literally felt like the dream collaboration. It's allowed us to support more women build long-term wealth, and in a way that's on our terms. For those of you who don't know about eToro, it's the leading social investment platform that's making investing more accessible for all. And we're really excited to be working with them to deliver a 3-part series on practical financial content. A quick heads up, we've got 2 more exciting webinars coming up in the next couple of weeks. You'll see QR codes on your screen right now, so feel free to scan and register them while it's fresh in your mind. I'll pause just so you can scan the QR codes. And now it's my absolute pleasure to introduce today's guest speaker, Dr. Heloise Greeff, who is someone that is truly inspiring. Heloise has a PhD in machine learning and an MBA from Oxford University. She's an award-winning AI researcher with a passion for turning complex data into smart, real-world decisions. No wonder why she's so brilliant at investing. Today, she is the most copied female investor on eToro's platform, using her bespoke algorithms to power her investment strategies. Her work has caught the attention of Bloomberg, The Economist, Forbes, and many others. You're going to love today. She's truly remarkable, and she's here to share how you can invest smarter even if you've got a busy schedule. It can feel really overwhelming, and we're here to just kind of remove all of that overwhelm. She's passionate about financial independence and helping women navigate the world of investing with confidence. Heloise, over to you.
Oh, thanks, Courtney. Thanks for that introduction. I'm so excited to be here. And I'll say, firstly, congratulations to all of you for showing up on a Wednesday morning when I'm sure you no doubt have a million other things to do, for a topic which we all know is really important, but can be really easy to ignore. And you can probably get away with ignoring it for a long time. So well done for showing up. That's a massive first step. And hopefully, like in return for that, to respect your time, I'm going to be as candid as I can today to share my own story. And hopefully by the end of it, you'll take at least one thing that you could do before the end of today to sort of get you going. Please feel free to ask questions. I have a presentation that I'm going to go through, but we don't have to get to all of it. I think it's more important that we, answer any questions as we go. And I really want to tailor it to be as useful as it is. And money can be a really difficult subject to talk about. It can be really uncomfortable to talk about, depending on like which culture you come from, how old you are. It doesn't really get any easier. So obviously the best way to begin is to dive right in and to ask you, how do you currently feel about managing your investments? I think we have a small poll that might be coming up, and just let us know, how do you feel about your managing your investments? And there really isn't any wrong answer here. I think despite me having millions of dollars copying me on eToro, I feel the whole range of emotions almost every day. So, um, is there a poll coming up? Oh, sorry, I can't see it. Sorry. Awesome. Okay. Yeah, really, like any of those feelings, emotions, even after 10 years, I still feel them, sometimes all in one day. So, all right. Okay. Yeah, just I think the core thing about today, and the reason I'm diving right in to ask you straight up how you feel about money, is because our mindset around money is probably more important than anything else, any of the other tips. And I hope to drive that home today, is that the way we approach money, the way we've grown up, and the things we think around money really influence the tips that you might take, and everybody else will take something else away from this presentation. But understanding at the core of it is our emotions, which is a really important part, which is something that I still like master, or I'm aware of every day, in mastering investments is really, really important. So let's see what the current feeling around emotions are, if we can bring up those results, please. Oh, yeah, a lot of people are feeling overwhelmed, but also curious and cautious. A couple are in control, so a good spread here. And it's okay to feel overwhelmed, because yeah, as I said, I still feel that some days. So hopefully we can get through a few tips that would just sort of inch you into feeling slightly more in control. So first up, just a quick disclaimer. None of this is investment advice. It's my own experiences, and it's intended for educational purposes. So always make sure that you seek, your own independent, do your own independent research. So, as Courtney said, I don't come from a finance background, and I certainly never intended to give a presentation like this, although I'm very, very happy that I am. But yeah, I came to Oxford from South Africa, and I was a biomedical engineer, and I was very passionate about addressing the healthcare gap in sub-Saharan Africa, which was something that I had seen. But I very quickly realized that a lot of people access healthcare because of waterborne diseases, because they don't have access to clean water. And so I spent the next 5 years working on getting people access to clean water, only to realize that a lot of those women don't have the financial freedom to even pay for that water. And at the same time, in my personal life, I had done my MBA and went back as a mature student to do a PhD, and struggled on the other side of the world with very similar things, not having, the financial freedom to make decisions, to choose relationship, careers, where I live, all of those things. So these things sort of happened at the same time in my life. And I think it was for good reason. And so not only do I now absolutely obsess about having that own financial independence in my own life, but also making sure that there are more women who have access to that. Because when I started my investment journey 10 years ago, the people I turned to, mostly male colleagues, friends, family members, about 90% of them told me, don't do it, you're going to lose money. And I now know 10 years later that backed up by research that women actually do better than men when they do invest. So if I can take you on that journey to not have those negative voices, that would be a great start on your journey. So we have another poll coming up, and this is around what do you do with your spare cash? We all have a little bit of money. You've all told me that you feel curious, you feel overwhelmed, but now I want to know, what do you do with your spare cash? And it's okay, wherever you are in the journey, this also will change throughout your life. Maybe you're currently paying off debt, or you're thinking about investing, or you're just keeping it in your bank account, just to get a feel for what people are doing with their spare cash. And this is a good place to share. There's no wrong answer here. If you ask me today, if you ask me next month, depending on what my goals are at that point, I could be doing something different with it. So this isn't a fixed answer. What you say today might be different when we meet, again in future. So yeah, let's see what people are doing with their spare cash. Awesome. We'll just give a little short pause for them to put together all the answers. But yeah, I'm really excited to see what people are doing. So most of you are keeping it in a saving account, and that's the safest thing to do. That's yeah, like a couple are auto investing, focusing on paying debt, really, really important, because those interest rates are usually higher than investing. So that's absolutely the right thing to be doing. I'm not sure where it goes. That's a good, honest reflection as well. So we're right across the board here. So let's start with that first question then, because I think we all sort of get stuck in this place, and this is my biggest regret, is wanting it to be perfect when I start investing. I was waiting for the perfect platform, the perfect trading signal. Then I was trying to get the perfect stock to invest in, or the perfect ETF. I was constantly, and when I look back, I probably lost 2 years in my journey waiting for this perfect moment. And the irony of it is, when I look back now, even when I did dive in when it was perfect, I still made a lot of mistakes. And so my biggest regret is not starting sooner, because it won't be perfect. You will make mistakes. One of the things I've learned in the last 10 years is that even the most experienced investors get a certain percentage, 5, 10, 20% of their investments that don't work out the way they do. So there is no perfect time to start. There's no perfect investment to start with. There's no perfect platform. The most important thing is that you do get started on this journey. So the first question I get answered, and I think a lot of you are currently there, is people say, um, I don't understand why I need to invest. I'm saving. And that's great. Saving is a really important tool to build a buffer against those short-term financial emergencies or goals that you might have. When we talk about investing, we're talking about a longer time horizon. Some people say 5 years, 7 years. I think it's from 10 years on. So you need to have both. You need to have both of saving and investing. They're not mutually exclusive. The reason why you can't just rely on savings is because the interest rates we get are often lower than the inflation. And currently, we are all experiencing it. I mean, they're calling it a cost of living crisis in the UK. But if, like me, you grew up in a developing country, you know that it's not temporary. Inflation will always mean that the price of things go up. And the pound, that what you could buy for a pound 5 years ago, today, in 5 years, it'll keep decreasing. So the most important thing is that you need to grow your wealth faster than inflation. And that's where investing becomes really important. But again, to stress, saving is still an important step that you have to do as well. So and many people start with saving. That's where I started as well. And I continue to save because I have short-term goals, which are, I won't be able to get access to that money in 5 years, but maybe I want to do something leaving in a year or two, and that's where saving is really important too. The next question I get is, well, I have a pension, so why do I need to invest? And this is a really powerful graph. Firstly, if you have a pension, great. Always max out your employer's contribution to your pension. It's basically free money sitting on the table. If you don't have your pension maxed out with your employer, start there. It's really, really important as well. But here's the sort of caveat to that. In the UK, we're currently seeing that the average woman's pension by the time of retirement will be just over £12,000 a month that she gets in annual income. And if you compare that to at the age of 65, when you retire, what your needs would be, that would be around £20,000. So you can see right from the onset, there is a shortfall in what her pension is giving her and what her lifestyle might demand. And while that pension will stay flat going into retirement, we know that inflation will drive that cost up. And so that shortfall will just become bigger and bigger as you age, and we are living longer. That's a fact. So investing again is really powerful tool to overcome the shortfall, but it's not the only sort of financial goal that it can help you with, but a really powerful motivator for a lot of people to invest. So why aren't women investing more? We have to remember that until very recently, women were not able or allowed to open even a bank account without her husband's permission. So until very recently, for me, 10 years ago, and I still hear these things today, we hear women are not good with money. Women are risk averse. Oh, you'll just lose that money. Oh, you don't know what you're doing. Leave that up to whoever else. We hear those things all the time. And even though we were not born less confident, we've been socialized to be less confident. And although that's changing, McKinsey recently found that over the last 5 years, 20% more women are becoming more confident with their financial decisions. It's momentum that we have to keep building on, and hopefully this masterclass will only speed that up. So it's important to remember that we aren't less confident. We've only been told over generations that we are, and that's what we're fighting. And compounded with that, we have this big confidence gap. Women are twice as likely as men to say that they're not confident in making those financial decisions. And the caveat of that is that I think the Dunning-Kruger effect explains it quite well. It's this trade-off between confidence and competence. When we first know nothing about a subject, we can be really sort of stupidly confident about it. And actually, a lot of people you talk to about investing are on this peak of Mount Stupid. And that's great. They stay there forever. But the downfall is that as you begin to get more information about a topic, you fall into this valley of despair and you suddenly feel overwhelmed by everything that you're not knowing. And I think a lot of you have said that you feel overwhelmed. So well done. You're off Mount Stupid. You might be somewhere here on the valley of despair, which is great because you already know what you don't know and you're collecting that information. So now it's just a matter of quickly getting up this curve of enlightenment to make sure that you become stable. And we keep getting told that women are risk averse, but it's been shown over and over that we're actually just risk aware. We just need more information before we make that decision. And that's where we can sometimes get stuck in this valley of despair. But just get up that curve and get the more knowledge and the more information you collect, the more confident you will become in your financial journey. And compounded with that is we all know that we have this multiple juggling act going on all the time. I put a triangle here, but this thing can have millions of different corners, pulling us into all different directions, whether it's your career, your relationship, children, your family, your self-development, your health. And then compounded to that is now we're talking about finances. So we have all these different priorities. They all have a different complexity, and we have very limited time to spend to them. So it's a big task to begin with. And hopefully, I can give you a couple of tips to not only build a smart portfolio, but a simple portfolio. And I have broken it down into four core elements that I think is really important for anybody who starts investing. Number one is to pay yourself first. Some of you have already shown that you are doing auto deposits, and that's absolutely a great way. That's how I started. I was a student when I started. I was on a stipend. I was earning about £1,000 a month, living in Oxford, paying rent. I had very little money left by the end of it, but I made sure to put £50 a month into my investment account. And so, without a doubt, I'm sure I can challenge you all today that you can put away £100, and I can promise you that you probably won't miss it. You will just look at that account in 5 years and you'll be amazed at what little, pocket of money has collected there. So pay yourself first. Not only does that give you the benefit of compounded interest, but for me, I feel it sets the intention. It tells me that I'm serious about this, that I'm serious and I'm taking responsibility about my journey, about my financial freedom. So, one is it makes it easier, it automates it, but it also sets the intention and the seriousness of it. And today, thankfully, we can automate it. We can automate the amount that goes off. And the next step would be to automate what that amount gets invested into. So you literally don't have to do anything, you just set it up. The next thing is to diversify and to make sure that you don't have all your eggs in one basket. And in the next sessions, we'll go through, Sam will definitely talk about diversifying as well, different stocks, different ETFs. But the core thing to remember today is by diversifying, you can reduce your risk of being exposed to one particular industry, one particular sector, or geography. So diversification is incredibly important. Number three is time. The question I get probably the most often after why should I invest if I have savings and investments? The next question is, but when is a good time to start? Is now a good time to invest in the market? Is it currently a good time? Or I have investments. Is now a good time to add more money? I hear that all the time. And my standard answer is if you did not start yesterday, the only better time is today. And here's exactly why. If we look at the stock market over the last 40 years, the average annual return, if we take the S&P 500 benchmark, the average annual return is 11.6%. So already you can see that return is a lot higher than whatever your bank is offering you on your savings. Um, and if we look at it by year, most years are green, a couple of red years, but we're in it for the long haul, so they sort of even out. And on average, the return has been 11.6%. Now, if we said that you were trying to time the market, you were trying to, sell high and buy low, and you were obsessively like looking at all the market, what's going on in the market. If you then just missed the 10 best days, just 10 days in 40 years, it's not a lot. That's like one day every 4 years. If you missed those 10 good days in the 40 years, look at what happens. The same money that you invested and did nothing to, you just left it invested, would at the 11.5% annual return, I think it was £10,000, would become nearly £700,000. If you now started to try and do something with it and you were actively trying to time the market and you miss those 10 good days, you end up with less than half, just over 200,000. So I'm not only telling you not to time the market, I'm actually telling you that by doing less, you get better results. You actually end up, and it doesn't seem like much if we subtract the 10 best trading days over those 40 years. you end up with 8.5% annual return. Still a very good return, but that 3% difference compounds over time and you actually end up with less than half. So I'm actually telling you to do less, to not obsess about the market, to not try and time the market, but just to stay invested in the market. And that is the hard thing about investing. That's why I started by talking about the mindset of investing, because that emotional roller coaster that you feel when the markets are going up, when the markets are going down, that's really hard. That is the hard part. That's probably the hardest thing that you're going to have to control. There's different strategies around it. You might ignore it, you might not look at it, but sometimes doing nothing in investing, once you've put the money in the stock market, I'm not saying not getting started, once you've started, leaving it alone can be the best thing to do, but that is also sometimes the hardest thing to do because it is tempting to sell when the markets are going down. So time in the market is really important. The next important thing is looking at the cost, the fees that you pay. If we take £10,000 and we invest it in the same, in two different products, they both give us the same return over the next 40 years. The only difference is the fees that we pay. One of them charges 0.3% fee, the other one charges 1.5% fee. Again, same return, but we end up with a £50,000 shortfall on the product that cost a higher fee, even though it gave the same return. Again, just the way that interest compounds over time and builds your money, fees also compound over time and eat into your returns. So people often obsessively ask me, what is the ETF I can buy? What is this thing? What is going to be the future return? Yeah, past performance is a really good indicator, but it's not a reliable indicator for future return. Do you know what is fixed? The fees. The fees are fixed. They're the things that's the thing that you have control over. That's the thing that you can choose today that can make a really big difference going into the future. So just to recap, we want to pay ourselves first. We want to take this serious. We want to make sure that we are diversified, reducing our risk. We want to have a long time in the market and not obsess about timing the market. And we want to control our costs. That's one really big thing that eats into our return that we can control. So to put a resilient system around this, because I think a lot of people obsess about this number three, which is what do I choose? What do I invest in? How long do I hold it? Really important as well, but you have to build a resilient system around it. Nothing that requires you to watch the market constantly. Number one is to begin by setting your goals. They can be different and they might change over time. You might be saving to buy a house. You might be you're looking at retirement. You might be wanting to send your children to university. Those goals keep changing through life as you get older. They keep changing and they have different time horizons, but be clear about what they are because it sets the intention and the plan for the rest of your investment strategy. Number two is to automate it. We're all super busy and modern tools allows us to automate the deposits and how they get spent every month, how they get allocated in the portfolio. So just automate it. I obviously actively manage my eToro fund where I have thousands of people copying me with millions of dollars. But in my family account with my, husband, that's all automated. That goes off at the beginning of the month from both our accounts and neither of us have to think about it, and that's makes it really easy, not only because you don't forget, but also you don't have that emotions of deciding, oh, is the market really good this month, is the market really bad this month. It eliminates that emotional aspect as well. Only the third part comes to choosing your core holdings, and then there are some satellite holdings that you can choose, which I call the play ones. They might be a particular theme or a country that you like, but choose your core to be really stable. That's 80 or 90% of your investments going into something which is probably pretty boring, to be honest. You don't have to reinvent the wheel here. You just have to do the first two steps, and then let the third step, guide you on choosing that core holding. And number four, which is also a bit important, but that's to have a predefined review loop. Again, this takes away that urgency for checking the markets every day. And this could be personal to you. Some people do it every week, some people do it quarterly. In our family, I mean, my eToro portfolio, I obviously check every day, but in my family, I check it every quarterly, and then once a year, my partner and I sit down and we make sure that our goals are still aligned, our family goals are still aligned. And if we do our review this year, we set the appointment for next year. And that's once a year. It becomes a lot less daunting when you have that defined review loop. So, another poll, one of our last ones, but that's just to see where you are with your habits and how that's affecting your money decisions. And really, again, there's no right or wrong answer here. This will change, but just to get a bit of a flavor of how do you think about money? How does money influence not only your investment decisions, but how do your habits, are you aware? It's really to see, are you aware of how, where your money is going, how these underlying emotions and thoughts are affecting the way you interact with money. And if you haven't read it yet, Morgan Housel's book, The Psychology of Money, is a really good reflection on sort of how our growing up affects our view of money. So let's see. Big amount is have FOMO, and that's really important to identify that as well. And then on the other extreme, a lot of you are avoiding risk, and that's just because you're probably not confident enough. You're here to collect information, and that's a powerful start too. Both of them are really important to collect the information. So you're here, you're in the masterclass doing that already. And a lot of you are waiting too long. I mean, I said that as my biggest regret. So it's nothing unique. And then that impulse spending, really important as well. I used to do that as well. A lot of emotional spending. And just becoming aware of that is a really powerful start as well, because there is a lot of uncertainty. And that's why I asked this question, because the next thing is when we do talk about emotions, there's a lot of uncertainty that comes with timing the market, investing, and all the emotions that come around money. I've tried to sort of break them into three, and that's just because I'll give some examples of my own. But again, becoming aware of how your brain plays tricks on you, not only when it comes to investing, but also when it comes to money. Just the act of becoming aware can become really powerful in allowing you to navigate the decisions that you make about investing. So, recency bias is a really important one because it's how news that we heard recently influences us. And the most extreme case, and one that I did a lot when I started investing, was because you remembered something that happened recently, you not only feel nervous about new bad news coming out, but you actually end up selling low. And that's that aspect I'm talking about when you take action, when you're actually supposed to do nothing when it comes to investing. The next one is loss aversion. This is on a spectrum for people, but for me, I hate losing things. I hate like having a loss. I hate like even losing my earphones. Like I have a really like strong tendency. Some people don't care. It's on a spectrum here and you have to sort of evaluate where you are. But I have a really strong loss aversion. And what that did in my investing was I would hold on to bad positions for way too long. And it's that finding that balance where you're saying, actually, a percentage of my investments aren't going to work out. I have to cut my losses because I can put that money somewhere else. So just becoming aware of what that bias or that aversion is in you. And the last one, which we all fall victim to, is social proof. So are you checking what friends are doing? It's great to check in with friends. It's great to talk with other people, but it becomes dangerous when it creates FOMO, when you're simply following what other people are doing because you're not doing your own research. So all of these are good instincts to have. They're what makes us human. They're what keep us safe. But the problem is if we're not aware of them, they trick us in particular ways. Because even if your friend is buying something, their investment goals might be very different to yours. So collect the information, but become aware of how it might be influencing your decision making. And you'll see that the core elements that we put together in the portfolio are also very much overlapping with addressing, navigating these uncertainties. Number one is again diversification. You've heard that earlier in the presentation. I haven't seen the future presenters, but I can guarantee you diversification will be a word that you hear a lot. Spreading your investments across different asset classes and industries prevents that highly concentrated risk that you can get. And it's a sure strategy to just reduce your own uncertainty. Number two is dollar cost averaging. Again, without like seeing the future presenters, I know that they'll talk about this as well. And this is the sort of boring part about investing, that you don't have to reinvent the wheel. Making those automated deposits at a fixed regular interval ensures that you're buying at high and low prices and it sort of averages out over time. It also reduces the emotional uncertainty of you needing to decide when to buy. And number three is rebalancing. So that's that review loop I talk about. Sometimes something in your portfolio grows a lot faster than something else. Like, for example, in the last few years, tech has grown a lot. So if you've had like exposure to tech, I used to be a predominantly tech portfolio in my eToro portfolio, and suddenly like I'm hyper exposed to tech. And, without getting into politics, when certain people open their mouths, tech is going up and down. So my portfolio became like overly volatile. And so just sort of reducing that back and getting some exposure to something else is what, has to happen. And then finally, time. That long-term mindset, doing less, but having the time, sitting back and having time is so important because as you saw over the last 40 years, the average annual return has been positive. So really all you have to do is have that time in the market. And that's because financial freedom isn't luck. It's about starting small, starting today. And if you didn't start when you're 25, start when you're 35. You have a bit more disposable income, so you can start with a bit more money. If you didn't start at 35, start wherever you are. Start today with a small amount. The only thing that you will regret is not starting. You won't regret like the money that you put away. I can guarantee that I've never heard anybody regret starting their investment journey. And finally, just be a little bit kind on, the uniqueness of your own situation. Uh, do you have lower investment confidence? Pick a strategy that overcomes that. Automate your investments. Use something like CopyTrader on eToro, which I'll talk about. If you are very risk averse, then choose a more diversified or passive strategy. If you feel very strongly about certain goals, choose things that align with that. For me, it was that I'm a very data-driven person and I used all sources of data. 10 years ago, I started using social media feeds. Now everybody's doing it, but use something that is unique to you, that you need to make sure your strategy fits you. So use what you have, but also don't be afraid to make it slightly unique so that it works for you. And then finally, use the tools. Technology is massively changing the playing field. It's making investing more accessible. Today, average retail investor has access to more information than hedge fund managers did 10 years ago. eToro has, I don't work for eToro. I'm only on the platform. I invest my own money first and foremost. And 7 years ago, I agreed to let other people copy me. I now have thousands of people copying me with tens of millions of dollars. And I don't really do anything else different. I invest my own money. I manage my own money. That's the most important thing that I do day in and day out. And I have opted to let, thousands of people copy me for no fee to them. But I also have nearly 200,000 people who follow me. And what that means is they just come and they have a little look inside my portfolio. They see what I'm buying, they see what I'm talking about. They can see my entire historical portfolio, what I've bought, what I've sold, for how much. And again, just having examples of people, maybe you don't want to copy, maybe you just want to follow, but just seeing what other people are doing can be a really helpful way to also demystify the whole process. So use what tools you have available to you to make sure that you can, just get started and get going. So I'm going to end off with this slide, and this is to challenge you to take one thing that you do at the end of this presentation. So a lot of you said you feel overwhelmed, so you'll be going down this path. Some of you said you feel confident. Maybe you feel overwhelmed and you don't have a lot of time. Just choose one thing on this list that you could do by the end of today. Maybe you're not ready to automate your monthly contributions because that, requires you to set up an account and it just feels too overwhelming. That's fine. Take a minute, book 15 minutes with yourself in your calendar. And if that's the only thing you do today, you've taken action aside from showing up at this workshop. Maybe you're on the other end of the spectrum. You feel really confident, you have a bit of time. Maybe you want to go and review your fees that you're paying for your current investments. So choose just one thing that you can go and do by the end of today, or maybe by the end of the week. And yeah, that brings me to the end of the presentation. So hopefully I've left a lot of good time for questions from everybody in the audience. Oh, Courtney, you're on mute.
Oh, here we go.
There you go.
Classic. Yeah, I was just saying thank you so much, Heloise, right on time, and that was incredibly insightful and empowering. Before we jump into questions, because I've got quite a few here, just a quick reminder, there are QR codes on the screen to download the eToro app. So like I said, eToro's copy trader function or feature is absolutely brilliant. It's a really, really amazing platform to get started. You'll also see a second QR code for the eToro Academy, which has lots of resources and guides and tools to help you continue kind of learning and on your investment journey. But I'll just dive into some questions, and I'll go with just kind of leading on from the eToro Academy. Heloise, are there any specific newsletters or podcasts that you recommend listening to, or that you listen to keep up to date with the market and kind of read on a weekly basis if it's a newsletter, or always listen into the podcast?
Yeah, I mean, when I started off 10 years ago, I started with the eToro Academy. They now have multitudes of more resources available, all for free. So it's a great place to start. But also on the eToro feed, if you haven't been on the feed, you'll see it feels very familiar in terms of like social media. So there's a
That's the
feed
feed in the app.
there. Yeah, the feed in the app. So people actually, including myself, sort of post their thoughts. So there's a lot of information there as well. It can be a bit overwhelming. But yeah, the Academy is a really great place to start. The app also gives market bite sizes. So it gives like a 10, 15 minute, I think sometimes even 5 minutes, really short, just to sort of give you a highlight of what's going on in the markets on that day. So it really depends again on how much time you have available, but the eToro Academy is a great place to start.
And how did you kind of choose, obviously when you chose, you've been with eToro for nearly a decade, I think now. How did you choose which platform to start with?
Yeah, I downloaded all of them. I started with a spreadsheet and I had a pros and cons list and I had the fees out there. And there were two, eToro being one of them, which had really low fees. And so I downloaded all of them. And unfortunately, I went with another one first. I'm not going to call anybody out, but I went with another one first. And I actually regretted it because I got stuck there for a very long time and I didn't realize that it was the platform. This sounds like a really horrible like breakup excuse, but I didn't realize that it was the platform and not me. Like I thought, oh, like I'm not good at investing, like I can't like get my head around this. But in hindsight, it was 100% the platform. Like it was one of the older ones. It was just like really poorly like displayed and it wasn't very user friendly. And so I lost about a year in my journey just thinking that, oh, this isn't for me. So in terms of fees, if you want to do like a cost breakdown and go that route, do it. I regularly still do it. eToro still comes out at the top, like spoiler alert. Um, but then just like download a couple, one or two maybe, and really play with them. eToro has a demo account, so you don't have to commit money up front to get started. But really, that I think the intuition and the user friendliness is really important. And I often hear people saying, oh, it's really overwhelming. But then I see them on threads and TikTok and like also, I'm showing my age, like I'm sure there are newer apps. It's like we keep adjusting to technology, right? So if you can figure out those things, then you can definitely figure out the technology side of this as well. So don't feel overwhelmed by that.
And that's, I mean, I knew you'd do something really strategic to like have a spreadsheet and analyze all the different platforms. So it's really useful to know that eToro has always kind of come up and out the best. From your perspective, this is kind of talking about the low fees as well. What are the most effective ways if you're a brand new investor, total beginner, and especially if you want low fees or diversification? Like, what are the most effective ways for beginners to start investing? I.e., is it a stocks and shares, ISA, or platform? Is it ETFs? Like, what would you advise as like a brand new investor?
Yeah, so number one is obviously the fees. The next one, which I haven't mentioned yet, but that's the minimum trade amount. And when I started 10 years ago, you know, a lot of places required like a minimum like £10,000 investment, and then each individual trade needs to be at least like, you know, a couple of £1,000, which I started with $300. I'm very upfront about it. I started with $300, and so eToro was also the perfect match in terms of their minimum trade position back then was $50, but now I think it's $10, if I'm correct. But essentially, it's really low. So with something like 300 or $500 or pounds at $10 a piece, you can get a pretty diverse, you could get like, you know, you can get at least 20, 30 different positions in your portfolio. So that's the other thing to consider is like not only the fees, but what's the minimum amount per position that they require you to trade. And there again, at $10, like eToro makes it really easy to be really diversified. The next layer to that, I would say, is if it's just too overwhelming, choose something that is a basket. So it might be an ETF. I know that's coming up in future sessions. Um, so a mutual fund that has like different things in it. Maybe it's copying somebody without like, you know, like I sit in day in and out and analyze things and adjust my portfolio. So have somebody else do it for you, especially if there's no fee associated to it. So yeah, just keep it simple. The ISA is obviously a really important wrapper as well, not to be confused with just investing. Like you're still investing inside your ISA. Toro has the ISA wrapper, so make sure that you do take advantage of like the tax efficient benefits of that.
Amazing. And I mean, and this is really another really nice segue. And I'm going to combine two questions that we have here, and it's kind of into that minimum investment. If you receive a lump sum of cash, e.g., from a bonus, would you recommend placing all of the value into stocks at once, or drip feed it over the course of the next 6 months? And then, kind of equal to that, how much should we be keeping savings versus investing as a percentage of what we have available per month?
Really good question. So I'm gonna start the other way around. So I'm gonna start
Okay.
the savings versus investing question. Um, I usually recommend that in terms of savings, you have a 3 to 6 month buffer, they call it an emergency fund. So you know what it costs you to run your house for a month. So have about 6 months in a savings account 3 to 6 months that's fairly accessible. What that does is it gives you a buffer if you have any emergency that comes up, and life happens to all of us, it just means that you don't have to access your investments. You don't have to access them maybe when the markets are not that good. So it gives you a bit of a buffer. So about 3 to 6 months. Then layered on top of that, if you have any short-term goals, maybe in the next year or two, you want to go on holiday, you have a big expense coming up, you should also be saving for in not in an investment. So that's not really a percentage, but that's a very sort of goal-driven amount that you need to calculate. And then in terms of investing, I work on a percentage of my income. So I try to put, they say 10%. I try to put 30% of my income into investing. For some people, that might be really high, but I just feel that, I'm happy to sort of reduce my lifestyle at this point to make sure that I get that. So pick a percentage, maybe start on the lower end, start with 10% of your income to invest and try and like sort of nudge that up over time. The reason I say a percentage is we can also have a lifestyle creep. So when you do get a bonus or you do get a pay rise, people usually keep that investment amount fixed and they start living a bigger life. But if you do it as a percentage of your income, your investment sort of grows with your income over time. So it just makes it a bit easier. Um, and then the second question around, gosh, now I've talked so much.
I mean, you've kind of answered it. So it was if you receive a lump sum of cash, e.g., a bonus, do you recommend placing all of this, or do you drip feed it? And
Yeah,
like you said, it's all around the kind of percentage model.
yeah, I think it's the percentage. And again, if you get a lump sum, I mean, it will be very individual to each person and where you are in your journey. If you feel comfortable, and you think you're going to risk spending it, just invest it, get it out of the way. That's what I do because I will always find things to buy that, like I can justify, I can sell like ice to my husband, like an Eskimo kind of thing. So I know that I'll get myself into trouble. So I just invest it. If you have more discipline, maybe you want to like put a percentage of it. Again, maybe you put half of it into the market now and you drip feed the rest over the next 6 months. The most important thing is that if you've decided that you're going to invest all of it, that you do actually get to the point where you have invested it and that you're not sort of like, because what happens is we start sort of like munching into it a little bit. Like if it's just sitting there, it can be tempting.
You almost need to kind of bite the bullet straight away, don't you?
Yeah, like I just usually pretend like that money never existed. So I just usually invest it straight away and I'm like, I never had it, like it never came, never saw it. I was never tempted by it. But that's just because I know like I'm not good in terms of like discipline with spending.
Great advice. And we have a really interesting question here. Could you give advice to about starting investing as a 50-year-old woman? It's a really popular question that's come up, like kind of beginning at a later stage in life, I guess. What would you say?
Yeah, I mean, first up, it's not too late. It's never too late. Like you're here, you've showed up, and the most important thing is that you just get started. The advantage that you have potentially over somebody starting younger is that you might be sort of in that peak stage of your income. So you are very likely having a higher income than somebody just starting up in their career. So you have an advantage in that sense where you have maybe a little bit more money. So the overall advice wouldn't be any different because even at 50, the current retirement age is 67. Very likely you'll work past 70. So you have at least another 20 years to have that money, working for you and potentially leave it well into retirement to keep growing. So you still actually have plenty of time, not plenty, don't get complacent, but you still have enough time to just get started. Maybe you just do a little bit more, but you also have more coming in.
Brilliant. Thank you, advice. And we've got a couple more minutes, and I've got three more questions. So I'm going to read them out, and then kind of maybe if you want to pick one, or if you can kind of give quick answers. So the first is, how many different investments should I hold to be properly diversified? The second one is, any tips for when you should actually sell a stock or sell your investments? This person has a tendency to keep them in their account long term and doesn't know if she should be selling. And then finally, any recommendations if you receive income in a different currency? When it comes to savings, could eToro manage one or two or more currencies? So yeah, they're the three questions.
Yeah, great questions. So how many different things should you keep? Again, that depends, because if you're talking about single stocks, the answer would be different compared to if you're holding an ETF, which is already like a basket of things. Um, if you're holding individual stocks, then, I used to hold between 40 and 60. It's way too much. It was way too much for me. Like, I couldn't keep up with them. It's a lot of work because it's not only what you have in your portfolio, but it's also the ones you don't have in your portfolio. So for every thing you buy, you've probably discounted like five other things that you've ruled out. So keep it to an amount that is manageable for you, the time that you have available. And if you don't have a lot of time, something like, copying somebody who's got like multiple stocks in there, or using an ETF, which is a basket of funds, sort of, it's one line in your investment, but it actually is a composite of many different things. So that can be a really sort of time efficient way of getting good exposure. And then making sure that they don't overlap. So if you have one of them like in the tech sector, like don't go and buy like a lot more tech things. So make sure that they're a bit different. So yeah, that is a sort of combination of how much time you have available. Um, the next question is around
When you should sell a stock.
yeah. Oh, that's the best question, because one question you always get is when to buy a stock. And then the next question is, when do you actually sell it? Really great question, because it can be difficult both when it's in a profit and in a loss. You could make a simple rule. When I started, the market was very different than it was now, but I had a simple rule that if my position was at 20% profit, I would close that position. It just made it simple for me. I could then decide to go in with the same amount or a different amount. But yeah, it just kept it simple for me. I knew when to get it out. So try and pick a simple rule, and know what that rule is when you're going into the position, because equally as important when you're buying something is you're actually only making the profit or the loss when you're closing the position. So make that rule when you're opening the position. So it could be something as simple as, when I hit this amount of profit, or when the price is like this much. So keep it simple. Stop losses can help with that, to again automate that process. And then finally, about multi-currencies. Yeah, that's a really great question, because a lot of us are sort of either from different countries or earning money in different currencies. eToro allows you to have it in your local currency, or for example, I have mine in US dollars because I, earned in dollars at the time. So I was putting in dollars. So it allows you to choose either your local currency. So it does give a bit of flexibility.
Amazing. That is all we have. I've learnt so much today. Thank you so much. My key takeaways are, obviously, investing is hugely valuable and important to kind of all of our lifestyles and freedom and financial empowerment. It's never too late to start. It's really start small, but most importantly, especially from Heloise, is like, be strategic. Don't just kind of not learn and throw it out and hope for the best. Like, be strategic. And eToro have some brilliant features like the copy trader to help you be strategic if you don't have enough time. So yeah, wonderful hour, and I hope everybody enjoyed it. Thank you for joining us today. Of course, Heloise, thank you so much for sharing your expertise and time and energy with us. Before everybody heads off, we would love your feedback. I think there's a QR code, and you should see a quick poll. It only takes a few seconds, and it really helps us, both Allbright and eToro, shape our future events and webinars. And we do have two brilliant webinars on ETFs and cryptocurrencies coming up in the next couple of weeks. So make sure you are signed up. Until then, have a wonderful rest of the day and happy investing, everybody. Thank you so much. Bye.